Well, it's crunch time for many of Australia's largest publicly listed companies. The 2015 annual reporting season is underway, and the news may not be good for companies relying solely on cost cutting to generate earnings. Even for the stronger ones among the pack, the subdued economic backdrop is clouding the outlook. There is one sector, though, that's positively glowing. David Taylor reports.
It seems it's tough going for many of Australia's top listed companies. On the eve of reporting season, there's growing pressure on CEOs to achieve revenue-driven results.
Sales really are the bedrock of earnings growth, and you can only cut costs to a certain extent.
Andrew Page spends his days combing balance sheets looking for value. He says too many companies, around 2/3 of the market, are still focusing on tightening their belts. Combine that with a growing trend of handing out big fat dividends, and fund managers say the big end of town is in danger of digging itself into an earnings hole.
Particularly these bluer chip businesses are getting more and more pressure to pay out higher and higher dividends to their shareholders, and therefore they're reinvesting less into their businesses as they lift their payout ratios, and that in turn is leading to less profit growth.
Here's how some of the heavyweights are taking shape. Profits from Australia's big resources and mining stocks are tipped to fall by 20%. The outlook for the financial services sector is better, but hardly worth celebrating. The CBA's earnings are expected to climb between 0 and 5%. Experts say the sector's gaining from strong credit growth and booming property prices in Sydney and Melbourne. AMP, Perpetual and Suncorp will also be showing their hands. But in a world of ever-rising asset prices, expectations are high and there's increased pressure for earnings growth. As for the rest of the market, it seems it's a mixed bag for companies chasing the consumer dollar. Outlets riding the housing wave should score well, but retailers that import their wares are expected to suffer from an earnings squeeze as the dollar falls. Broadly, analysts are expecting flat growth from the wider market, reflective of an economy running out of puff.
I think Australia in the last decade has really lived through the great complacency.
Matt Sherwood blames lacklustre growth on the end of the mining boom, and little by way of economic firepower from government coffers.
Quite clearly the economy is subdued and it needs a lot of reform to try to get it back up towards trend growth, which, despite the budget estimates, I still think is many years away.
While the economy slowly transitions away from the mining boom, analysts aren't hopeful of a strong earnings reporting season. One sector that does stand out, though, is the healthcare sector.
A lot of them have significant earning streams offshore, particularly in places like the US and Europe, so they're getting a big tailwind now from the falling Australian dollar, and arguably in a stronger economies as well than Australia is at the moment.
So there's any company, your CSLs, Computer Shares, Cochlear, Ramsay Healthcare, these kind of companies are going to get a bit of a kick.
All companies could use a bit of a kick. Even a strong profit result can lose points if it falls short of forecasts. This time around, though, Andrew Page says company directors may have a secret weapon.
So if we really are in a new normal of lower interest rates, I think that you can actually justify these values pretty well, you know. So we're not going to get much money in bonds and terms deposits and all that kind of stuff. So relatively, shares are going to look a lot more attractive, and we'll be able to justify trading at multiples that are higher than what you may see during more average times.
Companies won't be able to hide behind record low interest rates forever. But until clearer skies emerge, it makes a tough corporate environment just a little easier.